Good morning, everyone. Thank you for having us here today. I work with Price Bailey, so Simon Blake actually is one of the partners there who's due to speak today, but is currently unwell, unfortunately. So you've got me instead, which I hope's okay. Simon's our head of department and regularly acts in expert capacity in cases, along with one of the other partners, Stephen Reed from our Norwich office. So we do quite a lot of valuation work within the firm, including for expert capacity. I work alongside Simon, therefore, typically supporting him and Stephen in such cases. And although I've sort of been at the firm since 2015, the last 6 years have been within corporate finance themselves, with a particular focus on valuation work and forensic accounting. For instance, doing valuations for shareholder disputes, divorces, things of that nature, as well as doing other areas of corporate finance, such as employee ownership trust. But the focus today, for at least now, is on valuations and forensic accounting. So just got here a couple of slides really just to note what we're sort of going through today. So these are just a quick overview. So we'll do a brief introduction about Price Bailey, just as a firm, so you know a bit more about us. We'll then move on to talking about different valuation methods and different approaches when we're valuing businesses. We'll then also consider some external factors and how they can impact on the valuation assessment. So these tend to be sort of factors outside the control of the business, for instance, the environment in which they work. And then we'll also look at typical instructions that we receive and what that work tends to entail. So I appreciate there's a lot of I appreciate there's a lot of detail on that slide. But just really is an overview of the firm. So originally the roots go back to sort of 1938, and we're one of the largest regional firms now in accountancy, certainly in the region. We're based out of East Anglia, some offices in London as well, and we acquired a firm, Stevenson Smart, last year in Peterborough. So we've now extended our reach towards Peterborough, and recently opened an office in Oxford as a base as well. So we're very much East Anglia focused, and that's our heritage, but actually working across the country and sometimes with international links as well. So we're a member of the IAPA organisation, of which our managing director, Martin Clapson, is the chair of that. So, you know, if we're working on cases that have cross-border interests, for instance, we can liaise with firms in those countries to assist in cases as needed. Price Bailey is a traditional accountancy practice, I would say, in the main. We do accountancy services, audits, tax, payroll. We also have an advisory arm, which is where I sit within the corporate finance team. Across that, we cover, as it says on the right-hand side, there are a range of services. So whether that's looking at due diligence prior to deals, looking at mergers, acquisitions, etc., and of course valuations, which will be the focus today. The corporate finance team, I'd say, is probably one of the larger corporate finance teams in the region, although it's obviously a smaller part of the firm. So we're a team of about 20, led by 4 partners, across a team of about 450 people overall, the firm. So we'll move on to now for the valuation. And I've just put here a summary of the key valuation methods that we see typically applied when doing business valuations. And I'm going to talk through each in turn because they've all got their place. Earnings valuation, I would say, is one of the most popular valuation methodologies that we see, particularly where the business is of a going concern. It does have trading profits, and it's commonly also referred to as the market approach. So this is effectively valuing the business on the basis that we assume it will continue to trade as it does, and therefore we're looking at establishing what the underlying maintainable earnings are for that business. When we're doing a business valuation like that, we therefore typically look at things like the last 3 years' sets of accounts, for instance. What's the trading performance been? Where we're looking at year-to-date trading, because actually, if the year ends January and you're valuing a company in July, you've already got a position that's 6 months out of date. So where we can, we also try to make use of year-to-date trading and actually any forecasts that they may have at that point. It's also worth noting that actually if we're doing historical valuations, so say we're being asked to value a business back in 2020, then we'd make use of the information that would have been available at that time. So, if the business was forecast to do well and that didn't come through, then we look at actually what the projections were, what people at that time would have known. So that's something that we take into account there. And when we're doing an earnings-based valuation, What we're looking at there, for instance, is actually maintainable earnings of the business, but then in order to get to the end valuation, we have to multiply that what we call an EBITDA multiple. So that's, as it said on the slide, earnings before interest, tax, depreciation, and amortization. So what's the true underlying value of the business? And then we make use of, which I'll come on to the next slide, sort of other tools that we have available to actually apply a multiple to those earnings in order to calculate the business value before we adjust for things like the cash in the business and the debt. Because you could have two businesses that had the same trading value, but if one's burdened with a lot of debt, one's got a lot of surplus cash, then you need to recognise that, or we do, sorry, not you, we recognise that actually when you're looking at a business, there are different values there. Net assets basis is another valuation method. This tends to be, in some respects, the minimum value of a business. So it could, and that's just the way it is in the respect of sometimes you could have a business that actually, if it's not trading profitably, if it's not got that track record there of something to value, and it doesn't therefore perhaps look like there are maintainable earnings, then net assets tends to be a method to use because we're saying actually what's the balance sheet value? That is the minimum value. But that's not to say that that's the value of the business overall. For instance, you know, if you've got assets on the balance sheet, you can have properties in the company. They're not necessarily going to be shown at true value in the accounts. So it's quite often common that's part of our instructions. There might be, you know, a properties fair going out to value the property. So actually you can make sure that we've got an up-to-date valuation of those properties within our valuation. It's also worth noting that it's not just, you know, if a business necessarily doesn't have a track record of profits, it depends on the type of business that we're looking at. So for instance, if you've got a business that's very capital intensive, or asset heavy, so if you've got a property management company, for instance, that owns the underlying assets, yes, it's receiving the income through the rental fees, for instance, but actually the value of the property may well far exceed that. So in that case, that's where we're looking at sort of the values of the property within that. Similarly, if you've got a company that has lots of plant equipment that it's hiring out, some of those pieces of equipment can be, you know, £250,000, for instance. So if you've got several of those, is actually that worth more than the underlying asset. So it's taking into account different methods and sort of considering when it's appropriate to use them. But certainly the balance sheet is the starting point if you're looking at net assets, subject to, as I said, those sort of adjustments for changes in the values, particularly if you've got investments. You know, how's the value of the stock portfolio changed, for instance, which undoubtedly it would have done since the accounts were published. Revenue making, excuse me, is another form. Here we're looking actually at the revenue of the business and applying a revenue multiple to that. So some similarities to the earnings approach in the sense of the process that you go through, but we're starting, excuse me, from the revenue figure. Now, what this does effectively, it's more suitable to businesses that might be, for instance, subscription-based businesses. So if somebody's paying a monthly charge for something, you've got that recurring revenue there that's stable and that you can come through each time. And the reason we don't necessarily look to apply this in all instances if it's a normal trading business is because with a revenue-based business, you don't necessarily reflect the underlying costs that are involved in delivering that revenue. So that's why, for instance, if you have got sort of a subscription business, particularly if you think of something like Microsoft Office, you pay for that, but there's the cost to Microsoft for actually delivering that is very minimal because the product is already there, it's already in existence. But again, we'd still adjust for sort of non-recurring items within that, but it's just a different basis, therefore, to approach. And it's often something that we find we use if perhaps a business is a recent startup, and it sort of links in with discounted cash flow actually in terms of approaches you may use in that situation. But if a business doesn't yet have underlying profits, but it is generating revenue, then there's an argument to say that could be, you know, it doesn't have the trading history behind it, but actually is expecting to generate growth and therefore is already, you know, generating revenue. Discounted cash flow approach. It's really here we're looking at, and again, it can be similar to startups, where actually you might not only not be generating profits, you might not even be generating revenue because, you know, you're in the research and development phase of the business. So in that scenario, it's quite hard to value something where you've got the future value, but it's not there now. So by looking at a discounted cash flow approach, what we're doing there is effectively looking at what we expect future cash flows to be from that business and discounting that back to recognise the value of a single amount at a present point in time. This takes into account things like the expected cash flows and when those all hit across the period. And in order to do that, we use a weighted average cost of capital, which effectively discounts the fact that investors are giving up the chance to use other funds for the other sort of reasons for those funds now in order to invest in that. So you have to compensate them for effectively the loss of other circumstances in that choice. But discounted cash flows can be sometimes quite difficult to use in the sense that one of the key features that it needs, of course, is reliable forecasts. So that's something that actually sometimes can, when we're doing our work, that's something that you might struggle if the business doesn't generate that sort of level of detail. It can also be used for one-off projects, particularly things that are capital intensive, where you are expecting regular income flows. If, for instance, you're building, say, a multi-storey car park or a hotel development, there are various stages to be hit throughout that. So there is more sort of certainty in that regard. Or if, tech companies, quite often, if they're starting up, that's one that we see because they start very low, but actually once they've, on the right track, they're expecting very, very quick growth. And the last method on the slide is dividend yield, which typically we don't tend to see that often in practice where we're valuing a main business. It might be, someone has investment income from dividends, but in terms of the business itself, it's not something that we particularly see all that often. But when we're doing it, I mean, it's something that does require dividend history in order to be able to sort of track that against that. And also seeing what the policy is. I mean, just because a company has paid out a dividend one year, for instance, doesn't necessarily indicate that it will do so next year. The main benefit, where the main benefit of having a shareholding is the receipt of dividends, which might be something like a small shareholding in a listed entity. That's where some dividend yield tends to be used. So it's not something that would typically be approached where we were valuing a majority shareholding. Typically less than 25% would be when we use dividend yield. So I've discussed some methods there about sort of when we might use different approaches and how they work. And actually, when we're looking at share incentive schemes, for instance, as well, it's helpful to know sort of what's in those schemes, actually what the terms are the share options only exercisable on exit, for instance. Those can all impact value. So there's lots of different considerations when we're looking at how to value businesses. And I touched on briefly when I was talking about the earnings and the revenue methods in particular, normalisation adjustments. So what this means that effectively as part of our work, we definitely start from the accounts, the information available to begin with. But we also need to recognise that particularly with owner managed businesses, what we're seeing in terms of the accounts might not reflect what it might be if it were sort of the separation of ownership between owners and managers. So, for instance, it's quite common that actually directors might take a very minimal salary through the business and top this up with dividends. So therefore, when we look at an operating profit level, we haven't got the true cost of their time and their effort in the business reflected. So those are things that we seek to adjust to a normal market rate. Also things like choices that the directors make, for instance, if they're making charitable donations, very, very noble and well encouraged, I'm sure, but when we're looking at a business, you might have, another buyer may not make those decisions. So those are the kind of decisions that are being made that we think actually would not necessarily happen in a different scenario. If they're putting private costs through the company, those are the kind of adjustments we'd make as well. So for instance, personal vehicle costs, school fees, things of that nature. Because what we're trying to do really is to find that maintainable earnings level. So we need to make these normalisation adjustments in order to do so. That can also mean adjusting for business costs that are non-recurring in nature. If, for instance, the business has suffered a downward period and had lots of redundancy costs in the business, we wouldn't expect that to reoccur in future years. So actually we need to adjust for that. Similarly, we quite often look at professional and legal fees areas. Now, there's an argument to say that some legal fees are always one-off because, you do get retainer bases and things like that, of course. But, if there was, for instance, in that redundancy scenario, if there was then employment advice that was taken alongside that to complement the process, then again, that would also be treated as a one-off in most cases. We're also looking to a lesser extent, but still within sort of repairs and maintenance, are there items in there that perhaps ought to have been capitalised and therefore profit is looking lower than it might otherwise have been? And then we'll adjust for things, non-cash items, so depreciation, amortization, because they're not sort of affecting the earnings. It's more of the accounting treatment there. So we make those sort of adjustments to get to that maintainable earnings level. When we're looking at multiples, so we've done our research, we know where our business sits and the valuation that we're happy at sort of maintainable earnings level, and we weighted that perhaps across the year. So if we're looking at the last 3 years, typically we might expect that the most recent years is the best indicator of future performance. So we'd expect to perhaps place more weighting on that result than the previous years, unless there's something to indicate to the contrary. So we've got that sort of maintainable earnings level. And then what we're saying is actually, well, what multiple do we apply to these results to work out the value of the business? What typically would we tend to see? So in order to do that, we subscribe to various databases which enable us to access information on transactions that have taken place. Because when we're valuing a business, we're valuing it on an open market basis. So we're saying, actually, these are real life transactions that have also taken place. And therefore, where are the comparable companies that are similar to the one that we're valuing? And it might be that, particularly if we're valuing smaller companies, there aren't that many comparable companies around, either because it's a very niche market or because the size of the transactions that have taken place are significantly larger, and therefore a higher multiple is generally applied in those circumstances. So we do use multiples database research as a starting point, but it does tend to be a starting point because of those limitations. It's quite common, for instance, to see the same deal reported in different databases at different multiples. Now, there are ways we can sort of help with that. So depending on the level of information that is available, and often on the size of both the target and the acquirer, we can look at things such as the accounts of the acquirer and the accounts of the target in the time around the transaction or thereafter, in order to effectively manually calculate what we determine the multiple to be. So that's one of the ways we can sort of, to a degree, depending on the information available, look to address that. We also contribute towards the UK 200 SME Index, which is based on transactions that advisors like us and others have undertaken in the period, and submitting the data for those transactions. And that tends to be a bit more reliable as a base, because when we're reporting it already having made those normalization adjustments that I've talked about, which you can't necessarily see has taken place in the publicly reported deals. So we do tend to have a higher degree of confidence in using things such as the UK 200 market. But ultimately, a lot of it comes down to experience and sort of relevant industry expertise. I mean, I've been doing corporate finance for 6 years, and I wouldn't claim to be an expert by any means, but the people that I work with, they've been valuing companies 20, 30 years, so they're very, very well placed to actually say, does this make sense? Is this something that we see in the market? Particularly because alongside valuation work, we're still doing the transactional side of work. So to some extent, it's not just theoretical. We are also working on deals at the same time. So we are seeing actually what's happening within the marketplace, which is always very helpful. Coming on to sort of about minority discounts now. There's a useful fact sheet from the ACCA, which does set out and is used widely across the industry, the types of minority discounts that might apply when we're valuing a business. And this effectively recognises the fact that if we're valuing anything less than the whole, there's an argument to say that the value may not just be the pro rata value. So if actually you've got a 10-20% shareholding, you haven't got control of the business. The shares aren't freely liquid on a stock exchange or something like that. So there is in effect less of an appeal to a smaller shareholding in some circumstances than to have the majority, and that's something that the minority discount takes into place. It's worth noting, however, that the discount, the smaller the shareholding, the higher the discount, therefore, generally. But it can also be that you could have situations where a shareholding actually gives more of a strategic advantage. If, for instance, you have two 45% shareholders, that's the 90%, and you've got one person holding that 10%, well, then that 10% enables that, if voting with a 45% shareholder, and then gives them 55 and the power to have control, therefore. So we have to consider it in the round, and we're not just looking at the guidance, actually, what does that 10% shareholder have, for instance. Similarly, if you're valuing a 50% shareholder, what's the other makeup of that 50%? If it's held by one individual, then you've got a deadlock position. If it's held by 5 or 6 individuals, for instance, then that your 50%, let's say, is therefore of more value in some circumstances, because the other 50% is held by various individuals who would all have to sort of get on board. So there are, it's always interesting to see actually how the other shareholdings are structured, because that does have a bearing. And in our work, we also always consult things like the Articles of Association of the company, the shareholders agreement, if one is in place, to see if there's any guidance or stipulation in those documents that actually say whether or not a minority discount is or is not to be applied. And therefore we would then value in accordance with those. But quite often there is no such stipulation, and therefore, where appropriate, a minority discount is applied. But that also sort of links in with sort of quasi-partnerships here. So where we have, for instance, if you think about perhaps a small family-run business, where you have got the different shareholders, but it's because of that personal relationship and that mutual confidence, therefore, that decisions are made out of faith and sort of in good faith of the other shareholders. So in that scenario, you could end up with a shareholder effectively slightly disadvantaged by a decision. And in those circumstances, where the company has been trading in that regard, and that is therefore more of a partnership actually than otherwise could be seen as such, we might not therefore apply a minority discount if we can argue that it's a quasi-partnership, because if we're saying effectively there that in order to apply a minority discount would unfairly prejudice the minority shareholder. So that's something that we keep in the context of our work, and actually when we're looking at valuations, what's the trading reality of the business and how does the business function in practice? I'm just going to touch on now some valuation issues that we experience in valuation. And these are just a sample. Now, particularly things like COVID and Brexit might arguably to some degree be starting to settle down slightly. But they're still relevant where they fall into trading periods. So for instance, if we were looking at the last three years of accounts, etc., there might be some impact there. There's still businesses today that have CBILS loans that are to be paid, that may have received rates reliefs, etc. So artificially depressing costs. So these are still factors that we're seeing when we look at sets of accounts and valuations. And it's also worth considering, particularly if we're doing historic valuations, that they're still current issues in that respect. When we're looking at COVID impact, for instance, there are some businesses, of course, that didn't do very well in COVID, as it might expect. The hospitality industry, for instance, was very well hit, as we all know. Some argue that the retail industry is still not recovered fully. If we think about leisure, we have one client that was a tourist attraction. So 2020, this wasn't actually an expert witness case, but it's a sort of otherwise valuation case. Tourist attraction. So 2020, they were very badly hit because of the restrictions in place. But then in 2021 came along, and they actually did very well, because that was the year of staycation, where you could go away, but mainly in this country without sort of excessive restrictions. So they did very well in 2021 as a result. So you've then got perhaps a normal level, doing it your way, normal level drop, and then increasing quite significantly. So then by the time you get to 22, that's really then the new normal for them. So you've got effectively 2019 and 22 as the key years there, and the sort of the fluctuations in between. So in that case, it's thinking, well, actually, depending on what time you're valuing the business, is it start of a downward trend, or do you expect that you can maintain the peak in 21? Arguably not, but those are the kind of things that actually as a valuer trying to assess, is it a short-term issue, or is it the start of a longer matter? Some businesses, of course, were not really affected by COVID, particularly where, let's say, people businesses that were able to log on remotely from home. So you might have seen, for instance, a spike in IT costs, setting up workers remotely, etc. But otherwise, businesses continuing to trade to a degree relatively normally. And then some businesses that actually did quite well in COVID. Joinery companies that were making, funeral coffins and things like that, or gravestones. Cleaning companies saw a spike for sort of the spray misting as a service was very popular. And then some businesses that actually pivoted. So if you had a business that was, say, making perfume, but it could actually change the machinery to make a hand sanitizer, for example, then when you're looking at the accounts, you're thinking, well, actually, the business that's making the hand sanitizer is a very different business to that which is making the perfume. So it's keeping factors like that in our minds. Brexit, I'll touch on that. So, are there issues with cross-border trading? Extra administration can cause headaches for businesses, and actually is that slowing down the ability of businesses to respond to contracts, pushing up costs of doing so? For instance, are there any work permit issues that impact the business, perhaps particularly if it's in the farming industry, for instance? So that's a point to note. And interest rate as well in the inflationary environment. So actually, are there points where the cost base is increasing significantly, but perhaps the business has been locked into contracts with their customers where they don't have any room to negotiate? So when we look at periods, are we seeing actually that the margins of the business decreasing quite dramatically because they haven't been able to pass on that cost increase? I mean, we had one customer that's sort of working in raw materials. So whereas previously you may have fixed the price of wood on, say, a quarterly basis, it was now changing on a daily rate. And there was particularly in new contracts, he could write in clauses to sort of offset that, but had to honour the old ones. So it's interesting to see how that impacts as well as things fluctuate and need to build that in. And of course, supply chain limitations. Are there shipping container issues that we saw a year or so ago? Does that hold up the business? Are there shortages of key components that the businesses needs? The microchips for computer chips and cars, etc., was an issue a while back as well. So actually, how do they feature in and how do they impact the business? So we're looking at the business, but we're also looking at the wider environment and how that can impact, because the two are related. The typical instructions that we tend to see, as you might expect, one of the main ones is, of course, valuation of the business. And this can, as well, worth noting that the business can be across several entities. So, for instance, if you have a business that is a farm, for instance, but it operates some assets in this entity, some assets in this entity, and they don't necessarily, quite often actually, don't operate in parallel. On their own. So what you have got is assets in one business being used by another, etc. So we're looking at the business, therefore, as it trades, it might be across multiple entities. If you've got a husband and wife in a business, actually, what's their role in the business? Are they both actively involved, or is one sort of more of a silent partner? So those are things that we're considering actually when we're looking at valuations. Who are the key people behind that? Quite often we're also asked to value what's the liquidity in the business, to determine how much can be extracted, and what's the cash flow like, what are the funds that are available there. And when we're doing so, we actually need to consider not just the position as we see it now, but actually what the business may do in the future, because we're looking obviously at the ongoing state. So, are they likely to need to increase their borrowing needs? What's the working capital requirements for the business? So when we're looking here, we're not just looking at the fixed point in time. Where we can, we try and look across a year, because if you imagine at a period end, for instance, the business might have a lot of cash, but if it's then running a payment run for suppliers the next day, or it's got its quarterly VAT bill, for instance, then there is obviously going to make a significant change to the cash level. So by looking at it across a longer period, we can get more of a better idea, particularly, for instance, if it's a seasonal business. So if it's a business that trades very well in the summer, but it's very quiet in the winter, then it would need to hold cash reserves back to get it through those winter months. So those are the kind of factors that we look at. Are there any big capital expenditure items planned? Does the factory need a new roof that needs to be funded? These are all considerations that we look at. When we're looking at sustainable remuneration as well, that we look at that in all forms, because it's quite often the instruction. So we're looking here typically, actually, again, it stems from cash flow as a key point of that, but looking at their history. So have they paid dividends? So if you think, if you paid minimal salaries but have taken large dividends, then it indicates that you could continue to pay large dividends going forward, and therefore that could be the sustainable level of remuneration. There's also, of course, different tax implications of whether by bonus or by salary, and those are things that we can address as well to present the different options that are available. We're also asked to look at other ways in which the value could be realised. So once we value the business, how can that value be sort of realised? So that could be, for instance, a sale to a third party, sort of open market sale. And that would include, like I said earlier, talking about the key people involved in the business. Would there need to be a handover period, for instance? So quite commonly when someone sells a business, they'll have maybe a 2 to 3 year handover period, depending how important the person is in the business. Typically, the consideration might reflect that as well. So you might have, for instance, some cash up front and the rest deferred, or depending on some sort of earn out on the business's continuation. Where businesses are for sale, if there's less than a 50% shareholding, of course, that does restrict ability in the business to make decisions. You know, you can't pass an ordinary resolution. You need 75% for a special resolution. So when we're factoring in that, when we're looking at sales of businesses and shareholdings, those are important considerations as well. We also look at sort of share buyback as an option. So effectively, the company is buying back the shares of that individual. But it's important to look at actually how practical that is in reality. So if, for instance, there are limited reserves in the business, then that can prove difficult to do so and may not be a viable option. And quite commonly, we're also considered to be what would be the option of shares passing between the shareholders. So particularly if it's a husband and wife business and they can no longer amicably work together, then it might be actually what if the wife buys out the husband or vice versa. So that's something we also look at. And then we also, of course, as you might expect, look at the tax consequences of that, because that's often very important to the individuals involved. You know, yes, it's okay thinking that's what the consideration might be, but actually what are we seeing in practice? So we're also considering there things about who the party is, therefore. You know, if they're married individuals, then you've got the nil gain, nil loss treatment, inheritance tax, things like that, which are perhaps less of a concern if you're selling to third party, where capital gains tax 20%, or various other reliefs that are available. So we do also make comment on the reliefs that are available where that's applicable and where the conditions are met. And finally, we're also sometimes asked about other instructions. So it might not be a traditional valuation in the sense that that we would undertake it ourselves. It might be that they've already had a valuation that's been undertaken in the past, and actually they're looking for a critique of that. You know, because valuations are very much subjective, and you have got different valuers that, given the same information, will undoubtedly come to different conclusions. So therefore, it's sometimes helpful to have a sort of separate pair of eyes to look over those valuations and say, actually, oh, why, you know, help them to analyse what's been done. Is, for instance, something, you know, where would you raise the questions? Where would you think, actually, why have they applied this approach? Why have they made this adjustment? I'm not sure I would agree, etc. Are we expecting an answer doing it? Yeah, we're testing. Okay, good. I'm nearly done. And final point, also things about determination of losses. So actually, it might be, for instance, that someone has a franchise business, and then actually the person decides, instead of running that franchise, they're setting up a competing business and therefore diverting work away from the main business, as an example. So you might have, for instance, the franchisor is thinking, well, we're losing income because it's being diverted away, therefore. So what's the loss of that? Or similarly, what's the loss of opportunity of future revenue as a result of work being diverted away? So we do have, you know, quite common instructions in terms of things looking at liquidity, remuneration, value realization, and tax consequences. But there are also other sort of more forensic accounting pieces that we can look to do as well. And that's me done, actually. So fire alarm timely. But that was it. Thank you.